Welcome to the Chrisman Commentary, Daily Mortgage News Podcast. I'm your host, Robbie Chrisman. Topics on today's episode include buy now, pay later, and I guess that means pay in terms of your FICO score. My interview with Covius Pete Pannes on recent acquisition of Title 365 and its implications for scale and efficiency in the title space, and why Trump's talk of appointing a shadow Fed chair is weakening the US dollar. Thanks to today's podcast sponsor, Optimal Blue. Optimal Blue bridges the primary and secondary mortgage markets to deliver the industry's only end-to-end capital markets platform, helping lenders maximize profitability and operate efficiently so they can help American borrowers achieve the dream of homeownership. Does anyone pay with cash anymore? Or actually even have the money in their bank account? Credit card debt is now $1.1 trillion. With those buy now, pay later arrangements being added to the FICO reports, MLOs are asking, what are delinquencies like? Will these add to or subtract from my pool of eligible borrowers? That's funny because my friends are asking, will anybody ever be able to buy a house again? I clarned my burrito last week from Chipotle. Anyways, LOs are asking, what are delinquencies like? Will these add to or subtract from my pool of eligible borrowers? And to the surprise of no veteran LO, it turns out that nearly half have experienced payment problems. Want to do a client with a high credit card balance that's paying 28% or so on it a favor? Of course, you want to put them into a cash out refi, but that doesn't work. So for $1, have them join American Consumer Council, which gives them access to membership in normally off-limit credit unions. Some, like UFCU in Austin, will accept transfer balances into an account where the rate can be only 9.9%. 9.9 versus 28? Switching gears slightly, speculation about who President Trump may nominate to replace Fed Chair Powell has added fuel to the bond market's recent rally, with the possibility of a more dovish successor being introduced well ahead of Powell's term ending in May 2026. The market is interpreting this as a signal for earlier than expected rate cuts. This has driven a bid for treasuries, especially at the front end of the yield curve, with the 2-year yield falling to below 3.75%. It has also helped the dollar to weaken to a 3-year low amid expectations that a shift in Fed leadership could bring a faster return to neutral policy, which is currently priced at 3.0% by late 2026, and that rate and that timeline is well below the Fed's own projections. While Trump's critiques of Powell appear more political than substantive, markets are reacting to the idea that monetary policy could soon become more accommodative. Why does this matter? If a Fed chair in waiting is announced early and begins offering policy views during an extended transition, it could challenge the Fed's perceived independence and influence expectations well in advance of official policy changes. Any deviation from Powell's cautious approach, particularly if framed as a correction to a perceived policy misstep, would likely accelerate bond market rallies and increase downward pressure on short-term rates. However, such a move also increases uncertainty, both for the dollar and for treasury markets already grappling with concerns over tariffs and fiscal sustainability. With Powell still left to complete his term, investors are left to pick between the Fed's current guidance and a possible future defined by dramatically different leadership. For today's interview, I wanted to welcome to the show Covius Pete Pannes to talk about how M&A is shaping the title industry across firsts, seconds, and defaults, and scale and efficiency is contributing to the overall landscape. He's Chief Business Officer for Covius Services and is responsible for new client development and relationship expansion across Covius's origination, servicing, and capital markets business units. Covius recently acquired Title 365, and I'm hoping you can talk about the deal at a high level for people out there. What are clients telling you they need most right now in title or closing? Like, what are the needs of people out there in this modern lending landscape? And I guess you could be the obvious second part of that question would be, how does this merger plan to deliver it differently or better than before?
Yeah, good question. So clients right now, everybody wants better, faster, cheaper, right? And so one of the things this lends to the marketplace is a very singular focus around title-related products and services. there's faster search, there's what they call instant title or upfront title, right? Title 365 has been investigating providing that service. We have been investigating providing that service. I think the combination of the two entities allows us to go full speed into that. So, this is title at the front end of the origination transaction, and it can also be priced at a lower point because of the technology that's behind it. So, one of the things that we think will be compelling to the marketplace when we combine forces is we will be able to develop a product that's because we're both far down the road, but when we combine the efforts and make it a priority, push that into the marketplace, get that over the product development line, we'll be able to go to the market with a product that is essentially better, faster, cheaper, right? We also have the existing relationships on both sides. The Title 365 clients, remember Title 365 was a marquee name in title when the market was, much larger than it is today. We feel like they have a solid footing with some of the largest originators and servicers, folks that manage default title as well as those who originate. We do as well. Combining that feels like the right thing to do. Feels like there's a lot of leverage there. So we think we'll be able to develop a better product than each of us could do separately.
What gaps this addressed, or what opportunities you believe this provides for Covius? The rationale behind it.
Sure. Thanks, Robbie. Blend's owned it for a few years now, and this acquisition will significantly expand and scale Covius's position in the title space. We have been in the title space in some regard since 2011, mostly in default title. The old Lender Live platform, which became Covius, was a fee-for-service fulfillment space for origination. We also owned a companion title company, and then moved into the mod fulfillment space, where we ended up focusing most of our efforts around default title. So getting into Title 365 or purchasing Title 365 expands our footprint in title. We like to think of ourselves as title guys, in addition to some of the other services we provide to both originators, servicers, and cap markets. But this gives us a bigger footprint in title. The range of products covers firsts and seconds, as well as default title. Title 365 is also very steeped in default. So we think it broadens our footprint significantly.
Yeah, I want to talk about kind of the ideological necessity for this, if you will. Those are probably two big words versus what I should have used, but title's pretty fragmented and opaque when it comes to the mortgage process, both for borrowers out there, but also potentially companies that are interacting with. I'm wondering how you think this acquisition kind of moves the needle on efficiency, transparency, or cost to close, kind of all these things that people might be a little less clear on.
You hit the nail on the head with the word efficiency. So in one sense, you've got the Blend core client base, you've got the existing Title 365 client base, and then you've got the Covius client base. At Covius, we've got more than 100 MSAs. We do business with, a lot of these are closing agents and settlement agents and things like that. We've got almost 4,500 clients, but largely around servicing, origination, it's the majority of the significant portion of the market. There's some real efficiency to be gained when you take Covius client base and now offer them our expanded product set. Title 365 has a number of integrations that Covius Settlement Services does not possess. The integrations with origination platforms, the integrations with downstream providers around title search, and some of the instant title capability, that bridges a gap for Covius Settlement Services current client base and potential clients that are not our title clients, but buy other services from us. So really, we're thinking that the acquisition of D365, their tech platform, their advancements around integrations gets our clients to a better place. Our clients being defined as Covius Settlement Services. So the combination of the two, the plumbing and the efficiency with execution, should result in better service, faster execution, but better value for what they're paying for title in an expanded client base. For Blend, what they do best is, they're a platform that's software based around the origination side of the business, right? The point of sale. And so they feel like there's also an ability to leverage that on their current client base and grow what they provide to their client base around the point of sale. So efficiency across the board seems to be the common theme here, that both Covius and Blend came to the conclusion when we were talking about this.
Can you talk about kind of how you aligned the two, or after post-merger, how you will align them, and kind of how quickly lenders and servicers, people out there, will begin to see these benefits?
Sure. So there's a period of time between signature, which we announced on the 8th, and then close. So we've got past some regulatory confirmations, because title is a state-regulated entity, obviously, or a state-regulated product, rather, obviously. So, but we will combine Title 365 and Covius Settlement Services. We will take that newly combined entity, to answer your question directly, and we will also continue an ongoing relationship with Blend. Blend, has 22, call it 25% share, maybe even a little more, of the origination POS market. And so we both Covius and Blend realize that there's an important synergy there for the title space, or purchase of any origination product or service. In this case, it's title, but we will also take Title 365, the best of what they do, including the integrations I mentioned, the connectivity, the client base, and then what we do, which is we specialize in default title. We do some origination title, but we have gaps that Title 365 fills when it comes to technology integration, things like that. So we'll combine the two entities, and then we'll also leverage both back and forth between Blend and Covius services, both title and for maybe even the balance of some of the other services that Covius offers.
I was going to say, much like the mortgage industry at large, the title industry is seeing kind of a wave of M&A and vertical integration lately. Do you think scale is now almost a prerequisite to competing in this space, or is it still kind of about tech innovation and workflow flexibility? I guess all three of those things go together. They don't have to be mutually exclusive, but is scale a prerequisite as we move into the future of the title industry?
Yeah, I think scale for scale's sake, no. But if by scale, in this case, right, you take Covius Settlement Services, which is a smaller title company, you take Title 365, which is larger, but obviously scaled back since the market has. But between the two, yes, we get a little scale, but scale in and of itself, direct answer to your question, probably not. But if you take that scale and leverage it to, okay, how can we move faster around innovation? How can we upgrade our tech as a result of the scale? Then certainly, because in that instance, that's where you get the ability to maybe investigate things like that reduced priced upfront title, right? You get clear to close faster. You see some of the defects sooner, right? And the originator can address those upfront, as opposed to, in a part of the process that puts some friction into it where no one wants friction. So yes, I think it's important, but you've got to leverage that scale onto some of the things I mentioned. So scale alone, no, but done properly, sure. I think there are people that are subscale that still will be able to compete if they have the technology. I think there are people that are, well scaled, so to speak, that lack the technology. I think the sweet spot is you got to be big enough, and you got to leverage that scale to deliver some differentiators.
We're trending in a certain direction in the industry. The technology is advancing, borrower experience is advancing. What do you think that the future of title looks like in 2 to 3 years? Or kind of like, what does a next gen title experience look like in your mind?
Yeah, I like the question. So I think you're going to have a piece of the market that is going to be subject to the title waiver, right? I think for refinance, the agencies are, committed to a portion of that market, maybe 10%, maybe a little bit more, maybe as much as 15% would be eligible for a title waiver. The attorney opinion letters probably contribute a little bit more. Well, when I say contribute, I mean, probably take a little bit more of that market. maybe another 10%. The balance, I think, is traditional title. And I think it's really going to be incumbent on those who provide title to be very well connected across the board. You got to have all the integrations. And I think the winners and the folks that eventually, rise to the top over the next 3 years, to your question, are connected across the board to all of the appropriate entities. They deliver maybe two different flavors of product. One is a very tech-enabled upfront title product that is a better economic trade for the borrower. And in the case of a full Alta policy, where the policy is maybe for whatever reason, whether it's the access to the title plants or some technological limitation where the information is coming from, where that's not a case, then it's got to be a very SLA-driven delivery of your traditional Alta policy. So I think you hit those three things, and then of course of any claims payment and settlement service that results in doing the right thing by the lender or the borrower. You've got to have that on the back end. But as far as how the business might change, those three things on the front end, being fully integrated, effectively integrated. What can you do around innovation, around upfront title products and services that reduce the time and the cost? And then you've still got a core traditional part of the product that you got to execute well on.
And I guess finally, before I let you go, I'm not to belabor the point too much here, but how do you feel like this positions you over the next couple of years based on all those characteristics that you just mentioned are important in the title industry?
Yeah, I think this positions the combination of the firms as Title 365 comes together with Covius Settlement Services. One, it puts us in a position to be really formidable in the title business. It also gives that new entity the ability to leverage both the Blend platform of clients, right? Because we're going to continue a relationship with Blend ongoing and provide this service to their clients in a mutually beneficial way. And then you've got the Covius Settlement Services client base, which currently, there's a portion of that doesn't buy title from either Title 365 or our existing origination title services. So, over the course of the next 36 months, Robbie, I think we are really well positioned to, take a much more solid position in the title business.
Well, I wish you the best of luck. It was a pleasure chatting today, and I didn't know you and I we're so geographically close to one another. So hopefully we can catch up for lunch soon. Maybe I'll bring my dad or something like that. But for now, pleasure talking to you, Pete, and best of luck.
Thanks, Robbie. Same to you. Thanks for having me on.
Looking at the data, we learned yesterday that U.S. consumer spending grew at its weakest pace since the onset of the COVID-19 pandemic, on a sharp deceleration in outlays for a variety of services. And first quarter GDP was revised downward to the negative 0.5%, driven largely by a surprising slowdown in personal consumption, the weakest since mid-2020, and one that raised concerns about consumer strength. Trade and inventory figures also point to downward pressure on economic momentum, with the goods trade deficit widening and wholesale inventory shrinking. Although durable goods orders spiked, underlying strength in shipments offered only modest reassurance. Meanwhile, continuing jobless claims rose to their highest level since November 2021, suggesting more Americans are struggling to re-enter the workforce, even as initial claims dip slightly. On the housing front, pending home sales still posted a modest gain in May, up 1.8% month over month and 1.1% year over year, with all regions seeing some improvement, particularly the West. Still, housing market strength remains highly sensitive to mortgage rate fluctuations, which continue to outweigh positive wage growth in shaping affordability. And regional dynamics remain. The Northeast is facing a supply crunch that's driving prices higher, while the South, with more inventory and job creation, offers buyers more leverage. Separately, mortgage rates fell for the fourth straight week in Freddie Mac's primary mortgage market survey. The 30 and 15-year rates declined 4 basis points and 7 basis points to 6.77% and 5.89%, respectively. Those figures are 9 basis points and 27 basis points lower than a year ago. Today's calendar does have some market-moving potential, with PCE, personal income and spending, June Michigan sentiment, and remarks from no fewer than 3 Fed speakers. We begin Friday with agency MBS prices slightly better than yesterday's close, the 2-year yielding 3.72 and the 10-year yielding 4.24 after closing yesterday at 4.25%. Let's wrap up with a joke and some housekeeping. Have you heard of summer camp for husbands? Yeah, it's evening classes for men starting this month. Note, due to the complexity and level of difficulty of the content, each course will accept a maximum of 8 participants each. Topic 1 is how to fill ice cube trays and why to fill water bottles before putting them back in the fridge. Topic 2 is differences between laundry basket and the floor. Topic 3 is learning how to find things, starting with looking in the right place instead of turning the house upside down while screaming. Topic 4 is Health Watch. Bringing her flowers is not harmful to your health. Next topic is how to be the ideal shopping companion. And finally, there's a class on how to fight cerebral atrophy, which includes remembering birthdays, anniversaries, other important dates, and informing people when you're going to be late. Admissions are open.
Thanks again to Optimal Blue for sponsoring today's podcast. Optimal Blue bridges the primary and secondary mortgage markets to deliver the industry's only end-to-end capital markets platform, helping lenders maximize profitability and operate efficiently so they can help American borrowers achieve the dream of homeownership.